if you look at the rate with which the national debt is growing, I mean, even though the official budget deficits are not quite 2 trillion a year, if you look at the rate at which the national debt is increasing, and all you have to do is go to, the national debt clock on the internet, and you'll see that we're adding about $1 trillion of debt every quarter. So the national debt is growing by about 4 trillion a year. And we're not even technically in a recession yet. I mean, we probably are in a recession if you measure the numbers correctly. But the way the government has everything rigged, we're not in one. But eventually we will be. And historically, when we do go into a recession, whatever the deficits were prior to the recession, swell. I mean, they double or triple. And that's hard to believe that could happen given how large they are right now.
In this compelling analysis, Peter Schiff discusses the alarming growth of the national debt and the unsustainable rate at which it is increasing. He points out that despite official budget deficits not reaching $1 trillion annually, the national debt is soaring by approximately $1 trillion every quarter. Schiff expresses concern about the historical trend of deficits doubling or tripling during recessions, highlighting the current record-breaking deficits even in a supposedly thriving economy. He underscores the challenges of debt market dynamics, with major buyers like the Federal Reserve and Social Security trust funds transitioning from buyers to sellers. Schiff predicts a looming liquidity crisis, speculating that the Federal Reserve may resort to quantitative easing to navigate the economic challenges ahead, especially if the dollar weakens. He raises the specter of a potential financial crisis in an election year, suggesting that the Fed's independence may be compromised in favor of political considerations. Overall, Schiff's analysis hints at a precarious financial situation with the potential for significant market disruptions. With that, let's dive into the rest of the video to hear his full thesis.
It's when the economy is doing well and they keep telling us the economy is great, that's when you're supposed to have surpluses, to pay off the deficits. Now, we never have those, but at least in the past, when the economy was good, the deficits were smaller, and then they got larger when we went into recession. But now we have the largest deficits in our history, and we're told, we're not even in a recession, that the economy is doing well. So there's all this, debt on the market. Meanwhile, who's buying it? The Federal Reserve, which was the largest buyer of treasuries, the Federal Reserve is selling in competition with the Treasury. Also, the Social Security so-called trust funds, which used to be buyers of U.S. Treasuries not that many years ago, because Social Security had a surplus. They would collect taxes, payroll taxes, and then pay out benefits, and there was some money left over. And what the Social Security trust funds did with that money is they bought treasuries. Well, now, given how weak the economy is, how many people have left the labor force, there's a net deficit. Social Security, despite all these jobs that are out there, people have 2 or 3 jobs now, they're not paying enough payroll tax to cover the baby boom in retirement. So the Social Security trust funds are already selling U.S. Treasuries. So they've gone from buyers to sellers, just like the Federal Reserve. The other big buyers of Treasuries were the Bank of China, Bank of Japan. They're not buying anymore. So who's buying all these treasuries? I mean, I don't know. I don't know anybody who wants to buy them, really. So there's a huge problem. And that's why I believe that the Fed is going to go back to quantitative easing before the end of this year. I just don't see how we're going to make it through the entire year if the Fed continues to sell treasuries, especially if the dollar starts to fall, which I believe it will. I think that the main reason that the Fed succeeded in bringing down the official inflation measures, the CPI headline number, was the strength of the dollar. The dollar had a huge run in anticipation of all of the rate hikes that would be implemented to try to bring down the inflation rate. And I think it was the strength of the dollar. And the dollar index went up from about 90-ish to 115. And I think it was that dollar strength that brought down oil prices, commodity prices, and helped bring that pressure on the headline numbers. Well, the dollar has already backed off from 115 now to it's around 102, 102 and a half. But I think that we're going to fall substantially, probably throughout 2024, and that is going to reverse that progress. And I think right now, where we are on the CPI, where we're in the low threes, that's really the trough. And I think, sometime during this year, we're going to start to see the year-over-year inflation numbers headed back up. And so we never quite made it down to 2%, and now we're headed back up. But I don't believe that that's going to derail the return to quantitative easing, because I think the Fed is going to have to decide that higher inflation is better than the alternative. Because if the Fed does, pull the rug out from under the markets and, cancel the rate hikes that everybody has factored in, and continues to raise rates and continues with quantitative tightening, the whole market's going to implode. The stock market would crash, real estate, the whole fiscal situation, the banking sector. We could have a worse financial crisis than 2008, and all this during an election year. And I don't think that Jerome Powell is going to let his boss have to run for re-election in that type of environment. And I think for all the talk, the Biden administration wants to pretend that the Fed is independent. It's not independent at all. I mean, they're talking to Powell, and Powell's got his script, his marching orders, and I think he's going to follow it.
Peter Schiff delves into the misconception of safety surrounding U.S. Treasuries, dismissing the notion that default risk is priced into them. He emphasizes that the government's reliance on the printing press does not guarantee safety for Treasury holders. Schiff argues that if inflation is used to address the mounting debt, it essentially repudiates the debt, leaving investors without restored purchasing power. He contends that the U.S. government cannot honestly repay its colossal debt through taxation or spending cuts, pointing out the inherent flaws in the system. Schiff exposes the reality of the debt situation, revealing that a significant portion is set to mature in the next year, posing a challenge to find lenders willing to roll over the debt.
Yeah, well, I don't think there's any default risk priced into treasuries. And again, people just assume that the Treasury won't default because they've got a printing press. But that doesn't mean that owning treasuries is safe, because if the government has to create inflation to pay off the debt's not really paid off. It's repudiated. You don't get your purchasing power back. And we've already crossed that point where the debt is payable. It's not payable through legitimate means. The U.S. government cannot tax the American public to a degree that would allow it to honestly repay its debt. And it can't cut spending in other areas. The U.S. government is not going to cut Social Security so it can pay interest on the national debt. It's just never going to happen. In fact, whenever we get to the debt ceiling and they talk about, what's going to happen if we don't raise the ceiling, the first thing they say is, well, we're going to have to default on our debt. They never say, well, we're going to have to raise taxes to collect more income so we can pay our debts, or we're going to have to cut Social Security so we can pay our debts. The government tells us right up front, if we can't borrow more money, we're defaulting on the money we've already borrowed. I mean, they admit it's a Ponzi scheme. So the only way to avoid default is to inflate. But there is no viable way to honestly repay what's been borrowed, because we've borrowed way too much. The government can't do it. In fact, if you look at the nature of the debt, in the next year, just the next year, about a third of the national debt matures, which is over $10 trillion. And when you figure the new money we have to borrow, over the next year, the U.S. government has to finance about $15 trillion of debt. Well, who wants to loan us $15 trillion? Now a lot of that debt is the debt that's maturing. But the people who own that debt may not want to roll it over. They may want their money back so that they could do something else with it. That's what happened with a lot of the banks. That's why one of the reasons the banks were in so much trouble and needed these bailouts is their depositors wanted their money back because they had better places to put it. Like they could just put it in a money market and earn 5% loaning it to the U.S. government, the banks were paying nothing. And so the customers wanted their money back, but the banks didn't have it because they loaned it to the government themselves, for 10 years at 1%, or they loaned out a 30-year mortgage at 3%, and they didn't have the cash. So the U.S. Treasury is in the same position. So in order to prevent all of this, they're just going to print money.
In today's eye-opening discussion with Peter Schiff, we've delved into the alarming trajectory of the national debt and the potential consequences for the economy. Schiff's insights shed light on the challenges posed by surging deficits, historical trends in recessionary periods, and the concerning dynamics of debt markets. As we navigate through the intricacies of quantitative easing, the role of the Federal Reserve, and the risks associated with U.S. Treasuries, it becomes evident that the financial landscape is facing unprecedented uncertainties. Schiff's predictions about the dollar's trajectory and the looming specter of inflation provide crucial perspectives for anyone concerned about the economic future. We hope you found today's analysis thought-provoking and insightful. If you did, don't forget to subscribe to our channel for more in-depth discussions on finance and economics.